Okay, so this is the episode 2 of our mentorship sessions. Okay, so in this episode, we're gonna cover the forex market participants. Okay, now who are the participants or who are the people who actually participate in the forex markets? The first one are the retail traders. Okay, so who are the retail traders? These are the individual traders who engage in forex trading through online trading platforms provided by the brokers. These traders are private traders who trade their own personal trading accounts. Retail traders speculate on price movements of various currency pairs. So, retail traders are those traders, for example, the traders who just trade their own trading account from their home or from their own dedicated office. Okay, they are people like you, me, and every other traders who are not trading for banks or big institutions. They are rather trading their own personal accounts through a brokerage firm. Okay. So these are the retail traders. Now, the second portion is the institutional traders. Okay. So institutional traders, including hedge funds, asset management firms, mutual funds, private equity firms, investment banks, commercial banks, quantitative trading firms, pension funds, and proprietary trading firms participate in the forex trading for investment, hedging, and trading uh, purposes. So these traders are actually the traders who trade for big banks, asset management firms, mutual funds, okay, hedge funds, private equity firms, investment banks, commercial banks, quantitative trading firms, pension firms, and even the proprietary trading firms. These are the big boys. Okay, they trade. They don't trade their own personal account. They rather trade the companies or the investment firms trading account. They have a huge capital, okay, and they can make a significant movement in the forex market. Okay, so these are the big boys. We also call them as the smart money. Okay, so these institutions may execute large volume trades, impacting the market liquidity and price movements. Okay, so obviously they have the large capital. A bank may have a very, very large capital. Hedge fund may have a large capital, like up to $1 billion or even $1 trillion. Okay, so they have the capacity to shake the forex market, to move the to move the forex market in the way they like to move. Okay, so these are the big boys. These are the institutional traders. So if you want to be a successful forex trader, you need to follow the footprints or the footsteps of the institutional traders. Okay, so there's a common saying that 90% of the retail traders, 90% of the retail traders, those small traders who trade from their own home or their own dedicated office, and they trade their own personal brokerage account, and they have a very, very less capital, 90% of them lose money. Okay, only 10% of the retail traders are successful. So we are actually in the forex market, we are fighting against other retail traders and the big boys. These are the institutional traders. Okay. Then the third part and the third participant is the market makers. Who are the market makers? Market makers are basically the big firms like hedge funds, banks, and other investment firms, or they are the brokers. Okay, the brokers by which you are trading. Okay, these are the market makers. So market makers are the financial firms or brokers that provide the liquidity to the forex market by quoting bid and ask prices for various currency pairs. Okay, they buy and sell forex currency pairs from and to clients, aiming to profit from the spread, okay, and the commissions charged per standard lot. So what does it mean? They don't directly involve in the forex market. They are not speculating. They are just providing you the pricing uh, of the assets in the forex market. Okay, they give you the bid price and they give you the ask price, and you are involved in trading those bid and ask prices. Okay, and what they do, they 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 mark a difference between bid and ask price, and that difference is known as spread, and they profit from that spread. And of course, when you are trading on like when you're trading with the forex broker, you have to pay the commission, okay, to the broker in order to execute a trade. So they also make money from the commissions. They are not directly involved in trading. Okay. Now the central banks. Okay. The fourth player of the forex market is the central bank. Okay, national central banks play a crucial role in the forex market, implementing monetary policies and managing currency reserves. What they do, they implement a monetary policies that affect the pricing of the forex market. Okay, and they also manage the currency reserves. Okay, so you can say that the national central banks, for example, Federal Reserve from the US, State Bank of Pakistan from Pakistan, Reserve Bank of India from India, okay, and then we have the Bank of England from the UK, okay, and then we have uh, uh, so there are various uh, there are various central banks. And from the Europe, we have the central bank known as ECB. Okay, ECB. So it's like a Europe commercial bank, right? ECB. All right. So central banks intervene in the forex market to stabilize exchange rates. So they are not directly trading. They are not betting. They are not betting on the fluctuations. They are not trading on the fluctuation of the prices. They are actually making the exchange rate stable. Okay, how they do so? They do so by influencing the monetary conditions and sometimes even address the economic imbalances. Okay. Now, the fifth participant is a commercial company like Facebook, Twitter, Microsoft, Tesla. Okay. So what they do, these are the multinational corporations that engage in forex transactions to facilitate international trade. For example, when Amazon, which is based in US, they want to sell their their products to China. So what they're gonna do, they gonna exchange the US dollar currency into the Chinese yen, or sorry, into the Chinese yuan, okay, a currency in order to reach a trading deal, in order to successfully manage the trading operations in China. So they are actually exchanging the currencies from US dollar to to the local currency of the other country or their trading partner, okay, in order to carry out the trading activity. So they are not directly trading the forex market, but of course they are exchanging the currencies. So, and they have a huge amount of money. They can also influence the forex market. Companies involved in importing and exporting goods, as I told you earlier. So these companies, they just import or export goods. They are not trading directly on the forex market. They are just exchanging they are just exchanging or importing goods and services. Okay. Okay, and what they do, they just use forex market to convert currencies for conducting business transactions. They don't directly trade on the forex market, but they just use forex market to convert the currencies. Okay, that's it. Now the regulators and authorities, these are the last participant. Okay, the regulatory body or the government authorities oversees forex market to maintain and ensure compliance with the financial regulations. What they do, they just they just do a regulatory oversight. They just conduct a regulatory oversight. They oversee the forex market to to see that the forex market is in line with the compliance of the financial regulations. Okay, they protect the investors from fraud. Okay, and they maintain the market integrity. Okay, this is the role of the regulators and authorities in the forex market. They may impose rules and restrictions on forex trading activities to mitigate risk and safeguard market participants. For example, in US, CFTC uh, CFTC is the regulatory oversight or the regulatory body that oversees the futures and forex market. Okay, what they do, they impose the rules so that they can protect the investors from scams, they can protect the investors from taking a huge risk, and they can safeguard the market participants. So they make rules so that the investors and traders can feel protected while participating in the forex market. Okay, so that's it. Okay. And this is a figure that shows, uh, let me increase the size. Okay. Now, this is a picture you can see here. Let me do it 150. Yeah, this is fine. Now you can see CFDs market participants are institutional traders, retail traders, market makers, regulators and authorities, and of course, I have missed one portion of it. I will rectify it, and these are the commercial. Oh, sorry, I was seeing the mind map of the Forex CFDs market. So here are the Forex market participants: institutional traders, retail traders, market makers, commercial companies, regulators and authorities, and central banks. Okay, so you can read this document again to get a clear idea about the Forex market participants. All right, now we're gonna just make it to the original size so that we can go further. Now, CFD market participants. Okay, just like the Forex trading market participants, we also have the retail traders here. So retail traders, they are the private individual traders who trade their own personal account from the comfort of their home or their own dedicated office. Okay. So these traders, so individual traders who engage in CFD trading through online trading platform provided brokers, these traders are the private traders who trade their own personal trading accounts. Retail traders speculate on price movement of various underlying assets such as stocks, indices, commodities, and cryptocurrencies. Very simple. The second one is a market maker. You are aware of the market maker. Market makers are the brokers or the financial firms that provide liquidity and pricing to the CFDs market, just like the Forex market. Okay, they profit from the commissions and the spreads charged from the client or charged from the trader. That's it. They don't directly trade the CFDs market. They just profit from the fees, or you can say the transaction cost of fees of executing a trade on a brokerage firm or a financial investment firm. So market makers are financial firms or brokers that provide liquidity to the CFD market by quoting bid and ask prices for various assets. They buy and sell CFD contracts from and to clients, aiming to profit from the spread between bid and ask price and the commissions charged per standard contract. Okay. Now, the third part is the institutional traders. Institutional traders, they are the big boys or the smart money. They are the traders who don't trade their own personal account. Rather, they trade the company trading accounts. They trade for their companies. They trade for the corporations or firms. Okay, they don't trade their own personal account. They have a huge capital. They have access to huge capital, and they can move the CFDs market. Okay, they have the power to move the CFDs market because they have a huge capital. They may have a capital in billions or $1 trillion. Okay, and they can affect the Forex market. So institutional traders, including hedge funds, asset management firms, mutual funds, private equity firms, investment banks, commercial banks, quantitative trading firms, pension funds, and proprietary trading firms, participate in the CFD trading for investment, hedging, and trading, for the speculation and trading purposes. These institutions may execute large volume trades. As I told you, they have access to huge capital. They can impact the Forex market liquidity and the Forex market movements, okay, because they have a huge capital, okay. And the last parts are regulators and authorities. Regulatory bodies, as I've told earlier, when we were discussing about the Forex market participant, they also play a role in the CFDs market. Okay, these are the regulatory bodies and government authorities that oversee CFDs markets to ensure compliance with financial regulations, protect investors, and maintain market integrity. That's it. They may impose rules and restrictions on CFD trading activities to mitigate risk, safeguard the market participants. Just like the Forex trading, just like the regulators who act in the Forex trading or who engage in the Forex trading, they impose the rules or they create the rules, okay? And they also create restrictions on the CFD trading activities. And the only goal is to safeguard the market participants, to safeguard the retail traders and other institutional traders, okay, from the risk and frauds. That's it. Okay, so what's the difference between the CFDs market participant and the Forex market participants? The Forex market participants are 6. Retail traders, institutional traders, market makers, central banks, commercial companies, and regulators. Okay, now notice that CFD market participants are exactly similar to Forex market participants, but they don't have the central banks. Okay, they don't have the central banks. Okay, and they also don't have the commercial companies. Okay, while they have the institutional trader, retail trader, market makers, and regulators and authorities, but they don't have the commercial companies and central banks involved. That's the only difference between the Forex market participants and the CFDs market participant. You have to keep this in mind. So this is the conclusion of the episode 2. Okay, you have to read this document again and again so that you get an idea about the market participants for Forex and CFDs. Okay, and that's it for this video.